Picture this, a person in their early 40s walking out of an office for what they hope is the last time. Their mortgage may be mostly paid, their investment accounts may look substantial, and after years of disciplined saving they finally feel close to a goal that once seemed impossible. On the surface, retiring in your 40s appears to be a simple financial milestone, a point where accumulated assets become large enough to replace employment income. Yet beneath that appealing image sits a mathematical reality that makes early retirement fundamentally different from traditional retirement and significantly more expensive than most people initially realize. The reason begins with a simple difference in time. A traditional retirement at 65 might require a portfolio to support spending for 25 or 30 years. A retirement at 45 may require that same portfolio to survive for 50 years or more. The challenge is not merely doubling the timeline. The challenge is that uncertainty compounds across decades. Inflation changes purchasing power, markets move through multiple cycles, tax systems evolve, healthcare costs shift, and personal circumstances rarely remain static for half a century. Most people instinctively focus on the amount of money they need today. They calculate annual expenses, multiply by a number they have heard online, and arrive at a target. What often receives less attention is that retirement is not a snapshot. It is a long-term system. The portfolio is not simply replacing income for a few years. It must continuously generate purchasing power across multiple economic environments that have not yet occurred. To understand why retiring in your 40s is so expensive, consider a simple example. Imagine someone spends $40,000 per year. At first glance, $40,000 does not seem like an extraordinary amount of annual spending. However, if that spending must continue for 50 years, the total lifetime consumption becomes enormous. Even before considering inflation, the individual would spend $2 million over that period. Once inflation enters the equation, the real amount of purchasing power required becomes substantially larger. This is where many people encounter their first psychological misunderstanding. They see a large investment balance and mentally compare it to a single year of expenses. The comparison feels reassuring because the portfolio appears massive relative to current spending. What matters, however, is not the relationship between assets and 1 year of expenses. What matters is the relationship between assets and every future year of expenses combined. This is where many people encounter their first psychological misunderstanding. They see a large investment balance and mentally compare it to a single year of expenses. The comparison feels reassuring because the portfolio appears massive relative to current spending. What matters, however, is not the relationship between assets and 1 year of expenses. What matters is the relationship between assets and every future year of expenses combined. When retirement stretches toward 50 years, the assumptions become less comfortable. A withdrawal rate that appears sustainable over 3 decades may face greater pressure across 5. The retiree becomes increasingly dependent on favorable long-term market growth, manageable inflation, and the ability to remain flexible during difficult periods. Small differences that seem insignificant at first can produce dramatically different outcomes over multiple decades. Consider 2 individuals with identical portfolios. One withdraws 3% annually, the other withdraws 5% annually. In a single year, the difference may appear modest. Across 50 years, however, the gap becomes substantial because withdrawals influence not only current spending, but also the future growth potential of the remaining assets. Every dollar withdrawn today is a dollar that cannot continue compounding tomorrow. This introduces another hidden cost of early retirement. The individual is not merely funding consumption. They are purchasing freedom from future employment. That freedom carries a price because the portfolio must perform 2 jobs simultaneously. It must provide current income while also preserving enough capital to generate future income decades later. Psychologically, this can create a surprising tension. Many people imagine retirement as the end of financial concern. In reality, very early retirement often transforms financial decisions rather than eliminating them. Spending choices become connected to portfolio longevity. Market downturns become more personally relevant. Inflation becomes more visible. The retiree may possess greater freedom over their schedule, while simultaneously becoming more aware of long-term financial sustainability. From the past history, it provides useful perspective. Throughout modern economic history, investors have experienced periods of strong growth and periods of disappointment. There have been decades marked by rapid inflation, stock market crashes, recessions, geopolitical uncertainty, and changing interest rates. Someone retiring at 65 may only encounter a portion of these events during retirement. Someone retiring at 45 could potentially experience several complete economic cycles.